frazzles me a little bit. So I just want to welcome everyone today and good morning to the Ortencio Group Market Outlook webinar. Before I begin, I just wanted to send out our thoughts and prayers for those in Fort McMurray that were affected by the natural disaster last month. I just read today the good news that the residents are slowly being allowed back to their homes. The silver lining coming out of this whole situation is the outpour towards these residents that they've received from fellow Canadians in the rest of the world. As always, I have joining me today is Gareth Watson, Director at Richardson GMP and a key member of the investment management team. Many of you have seen him on TV as he's been a frequent guest on BNN and several other business shows. So welcome and thank you, Gareth.
Good morning.
In today's presentation, we're going to review what's happened over the first half of 2016. And Garrett's going to provide us this outlook for the balance of the year. He'll go over his market and economic outlook in Canada, the U.S., and the rest of the world. We're also going to be discussing the unprecedented volatility in the currency market, along with the strong recovery we've seen in oil. We'll address key events that could have an impact in the global economy. Upcoming topical events in the news, such as Brexit, the possible exit of Britain from the European Union, and of course the U.S. election, and the possibility that the charismatic but polarizing Donald Trump could possibly be the next president of the United States. So there's lots of things to cover. I think this will be an interesting webinar. Before I hand it over, I wanted to go over. Before I go into what's happened today, I want to go over 2015, how things are a little bit different now. Let me just see here. Okay, there you go. Sorry. So in December 31st, 2015, the TSX underperformed for another year. The rest of the stock markets around the world did not do well either, but the strength of the U.S. dollar, as you can see in the slide, converted to double-digit returns. So, for example, the TSX was down 11%, the S&P 500 was down slightly, just below 1%, but with the strong U.S. currency, it was actually up 18.2%. This was in December 31st, 2015, and the rest of the other markets globally followed. Another key component, of course, is WTI, which is the oil prices. It was at 36.60 at the end of the year, and we saw that, the start of January and February, that downtrend continued, and with most of the rest of the markets. In fact, oil, I believe, touched $32 a barrel. As I move over to the next slide, it's been an interesting ride, to say the least. So as of May 27th, the numbers are, fairly the same at the end of the month yesterday. The S&P TSX was actually up 8.42% for the year. So they've had a good recovery. So now they are one of the better performing markets around the world. The S&P 500 is up 2.7%, but with the strength of the Canadian currency, it's actually down now 3.25. So you can see the difference from the end of the year to what it is now. And the same goes for Europe, Australasia, Far East, which is down, but even more so with the strength of the Canadian dollar in emerging markets. The other story, of course, is WTI, which is with oil, where it closed at 49.33 on Friday. In fact, it touched $50 at one point, and that's obviously been helpful to the Canadian dollar, which is now at about $1.30 US. So that's what's been happening of late over the last 5 months going into June. So now I want to turn it over to Gareth, and he can provide us with his outlook going forward.
Great, thanks, Frank, and good morning, everyone. Thanks again for joining us today. I do have a number of topics to go over. As Frank mentioned earlier, there's a lot that we can talk about. I am going to try and limit my comments to about 20 minutes, so I'm going to try and give you a broad brush and overview here of what we're looking at, mainly looking forward. Just very briefly on the first, well, I can't believe, first of all, it's June the 1st. That absolutely shocks me. This year has been flying by. But the first part of this year, I think, can be characterized as kind of not really two halves, but certainly two sentiments. The sentiment at the very beginning of the year was extremely negative. We had an absolutely horrible January. There were many, as we call them, Debbie Downers in the market, people who just had extremely pessimistic outlooks on a lot of different things, whether it was the Canadian economy, the Canadian dollar, oil prices, which resulted, I think, in the market overreacting in many ways to the down. We have seen a reversal since then, started probably in February, moved through to March, April, and now, of course, we've gone through May, where markets have recovered, where the loonie did actually touch 80 cents at one point, which surprised the living daylights out of me. Oil prices have rebounded, and perhaps to some degree we had a bit of an overreaction to the upside. So what this means is that we've had certainly an increased level of volatility in Canada, at least Canadian markets, for the first part of 2016, and that's probably not going to change for the rest of the year, namely because we have a few events coming up here that are going to maybe, perhaps in some way, add to that volatility. So let me just touch on, and I always throw this slide in my presentation. We talk about the themes that we outlined at the beginning of the year just to see how we're doing. Really not a great deal has changed. Global divergence still continues, and by that I mean that the United States of America is still on track to raise interest rates, whereas the rest of the world, you're unlikely to see other countries follow suit and raise their rates in 2016. That divergence has been going on, of course, since the first rate hike back in December. We have been all over the map on economists and strategists with their rate forecasts, and to the point now I don't listen to them anymore, because we had, at the beginning of the year, we were supposed to have 2 rate increases. Very quickly that went to 0. Then very quickly we're saying that we were going to see rate cuts. Then, of course, people saying, well, there's no way we're going to raise now until December, and now before we know it, of course, there's a hint that you could see a rate increase in June or July. So my point being here is that we're all over the map on this. Don't pay too much attention to all these talking heads on the street. Just have an expectation of probably 1 or 2 more rate hikes in the United States this year, and we'll just move on from there because no one else is going to do anything else. Now, we have always been of the view, and certainly at the beginning of the year, there were people that had contrary views to this, that there would be no recession in the United States in 2016. You might not have thought that in January with the way some strategists and economists were talking, but we certainly think that the U.S. economy is still relatively strong, and I'll touch on some things later in the presentation about that. What we can say, though, is in other parts of the world, such as Europe and Japan, monetary policy, which used to help the markets a great deal, there seems to be a little less faith in what central banks are doing and the effectiveness of their interest rate policies and actually impacting different economies and therefore different stock markets. The Europeans and Japanese are in a negative interest rate environment. It's an area where we don't have as much experience, and therefore the outcomes are a little unknown. So that has created a bit more volatility in those parts of the world. And in Canada, I know that obviously the western part of our country has come under considerable pressure, namely because of the oil and gas industry. And of course, there's other parts of the country that are under pressure because of that as well, certainly out in Newfoundland. And there's a number of industries that support oil and gas all across the country that have seen business decline. It is going to be a tricky year here, and we might not feel it as much, perhaps maybe if you live in Ontario or Quebec, but you're definitely feeling it if you're out in Western Canada. And unfortunately, this is just part of the natural cycle of commodities. Commodities go up and down over long periods of time, and right now we're in the down cycle. But I'll touch on oil a bit later, which unfortunately that outlook remains poor at this time. So I did talk about interest rates. I won't spend too much time on this slide because, well, as you can see, no change, no change, no change. Our expectation here for the United States, again, 1 to 2 rate increases in this year, which, of course, in the bigger picture of things really isn't a big deal. I mean, we're talking about 50 basis points, but of course, because we haven't seen rates go higher in the United States in such a long time, it is a bigger deal just because the markets want to know how the U.S. economy is going to handle these higher borrowing costs. Now, I actually believe that the U.S. economy will easily handle a couple of rate hikes, no problem. I mean, we're talking about working off of a very low base of 0, moving up to, 0.25, 0.5, 0.75. I don't think that that is going to derail the U.S. economy whatsoever. But the key thing here that I think you have to watch out for is the U.S. dollar. It could get some support. There's some debate as to whether it will with rate hikes, but it should get some support and strengthen, which is not good for other currencies around the world. And yes, obviously not good for the Canadian dollar. But for some emerging market economies that are pegged, or I shouldn't say, or that are pegged or even unpegged to the U.S. dollar, those changes in currency can be very influential on their economies. So with rising rates in the United States, I would say that the concern for me is less with the actual impact of the U.S. economy and more on the global impact because of these emerging markets that tend to have a relationship to the U.S. dollar. And as we
We're
look
seeing a bit of that too, right, Gareth, where it seems like good news in the U.S. Means the possibility of a rate hike, and when that expectation on that day occurs, there seems to be a bit of a pullback in the global markets.
That's correct, and that's just an expectation that there will either, if you don't peg your interest rate, or sorry, your currency to the U.S. dollar, first of all, your currency will weaken, which in some cases is a good thing because that makes your goods cheaper and you become an exporting, you become an exporter, which might help your business. But certainly, if you peg your currency to the U.S. dollar, that's forcing the cost of your currency higher, which makes you less competitive. And of course, a lot of countries will peg their currency to the U.S. dollar to make them more stable, but that does come back to bite them when, in fact, the U.S. dollar strengthens. They become less competitive globally. So those are things that we do have to keep our eyes on for sure. I did talk about the United States, the fact that we didn't expect a recession this year, still don't, and in fact, there's just not enough time, I think, for a recession to enter the picture here, and we're going to start talking more about 2017 and beyond. But simply put, growth in the United States is stable. Now, it's certainly not accelerating like we saw a few years ago when it was coming out of recession. It's not supposed to accelerate for an extremely long time to the degree that it did a couple of years ago. So I'm not concerned about the growth rates. I still think they're quite healthy. I think the consumer is in good shape. In fact, yesterday we saw a statistic. It was personal spending in the United States. It was as good as it's ever been since 2009 in terms of the year-over-year growth. So that was a positive signal for consumers. Perhaps some of these consumers now finally spending what we call the oil dividend, which is the extra money going to their pockets from lower gas prices at the pump that they've had for a couple of years. They hadn't been spending it as much as we'd like to have seen, but hopefully now they're starting to feel a bit more comfortable with the economy and putting some of that extra cash to work. The employment market is strong. Sometimes we see a few blips here and there with the employment report relative to what economists are forecasting for job growth, but jobs are still being created in the United States. Most importantly here, and I think this is what's driving some of the chatter on the interest rate increase, is the fact that inflation is creeping a little bit higher, very marginally higher month after month, and this is very key. You want to see inflation going up when you're raising rates, or usually I should say the other way around. You raise rates when you see inflation go up. The one thing that would be disastrous, of course, is if you raise rates when inflation's going down, because, of course, raising rates makes things more expensive, or it raises the cost of borrowing. And what happens there is that it does tend to put downward pressure on prices because we don't spend as much. So if prices are already going down and you raise rates, then you're going to exacerbate the problem and potentially cause deflation, which is not what you want to see in your economy. But as of right now, inflation certainly at a level where I think the Fed feels far more comfortable in moving rates higher. And of course, I can't talk about the United States without touching on the election. And in all honesty, we could do a whole webinar on this topic alone, but I'll try and be brief and to the point here.
And we may, just based on the level of interest out there. So
yeah, possibly, but I believe, yes, Frank did put this slide in here into the presentation. It does, first of all, Donald Trump does now have the delegates to become the Republican nominee. So that is basically official to a degree. I guess it's not official until it's official, but he is the designate nominee. Hillary and Bernie are still duking it out, even though the math is completely against Bernie. So it does appear that we will have a Hillary versus Donald presidential election, even with all the chatter still out there about a potential third-party candidate, although I think it is technically too late in a lot of states to get on the ballot now, unless I think back in the end of April or some point in May were some of the deadlines to have your name on the ballot in some states. So I think it is probably too late, technically speaking, officially speaking, for a third-party candidate to come in. But I'll be blunt here when I say that I don't think the outcome of the election will have a massive influence on the United States economy, on its budget, on its markets. And the reason why I say that is 2/3 of the U.S. budget alone is spent on Medicare and Social Security. That's something that usually presidents don't influence a great deal. Admittedly, over time, things have changed a bit. I mean, certainly President Obama brought in new health care reforms in his presidency. However, to think that one man or woman can single-handedly destroy the U.S. economy, it takes a lot of people to do that. And more importantly, we also have to remember that the United States does have a three-tiered government system. It has the House, the Senate, and the President. And there's a whole bunch of checks and balances in place. And this is why they usually don't get a heck of a lot done in that country, because they have too many people fighting each other at different levels of government. I just don't foresee, no matter whether it's Hillary or Donald, them really essentially trashing the U.S. economy on their own. The two areas where I think that they do have impact on the economy is on taxation and trade. Now, on the trade front, Donald and Hillary appear to be a little negative on trade, but for different reasons. Of course, Hillary wants the support from the unions, and of course unions don't necessarily like trade agreements because they usually tend to see jobs leave the United States. Donald doesn't like the trade agreements that are currently in place because, of course, he thinks he could have negotiated better deals. So it'll be interesting to see what happens on the trade front with either of these two in office. Certainly some uncertainty no matter what party takes over the presidency. And then on the taxation front, both have actually signaled, and this is the surprising thing about Donald, although Donald changes his mind a lot, so he could change between now and November. But both appear to be willing to tax the higher income earners of the United States at a higher rate. That appears to be coming down the road. Donald has hinted he does want to cut corporate taxation, which is actually quite high in the United States. I think it's about 35%. We here at the federal level in Canada, we worked our way all the way down to 15% between the Liberal and Conservative governments. So there is certainly some room for cutting on that front. But taxation will be interesting because, of course, that means government revenues coming in, but also at the personal level, what is that going to do to consumption, especially if they do start to tax the rich a bit more down the road, which of course is what we've seen here with our government in Canada. So there are certainly some question marks, don't get me wrong. There is certainly some uncertainty. If Trump were to win, I think that there would be a bit of an uncertainty factor in the market, but I don't think it would last very long. And I think that's the key for you to take away here. Now, for some of you wondering, is it really possible that Donald Trump could win the presidency of the United States? I would say at this point you cannot dismiss that. And I'm not just saying that without looking at numbers here, because if you look at the Electoral College, which is what the United States uses to determine their president, my goodness, it is an archaic system, don't get me wrong, but you will see some states, and I feel sorry for the people that live in these states because they are going to be absolutely bombarded for whatever we've got left here, 6 months worth of commercials. But places like Ohio and Pennsylvania and Florida, if Donald Trump somehow can flip those to the Republican column and keep all of the Republican states that Mitt Romney won in the last election, then it is mathematically possible for Donald to get the presidency. Certainly Ohio and Florida are going to be huge battleground states. Pennsylvania hasn't, I think, been Republican since Reagan defeated Mondale all the way back in the 80s, but those two states alone are going to be huge battlegrounds. So I certainly can't dismiss the possibilities that we could see President Donald. But again, lots can happen between now and November. So many things can happen between now and November. It's really up in the air. So let's just move on quickly here to the United Kingdom. We have a couple of events. Of course, the American elections in November. In June, I believe it's the 23rd, the United Kingdom is having a referendum as to whether or not they're going to leave the European Union. Now, the European Union, just to differentiate between the Eurozone and the European Union, the Eurozone is the group of 18 countries that uses the euro as their currency. The European Union, I believe, has about 28 countries and is a broader union, both socially, politically, economically, that brings most of Europe all together into one block without using the same currency. And of course, the United Kingdom is part of that because they don't use the euro, but they use the pound, but they're still part of this European Union agreement. Is it a possibility that they could leave? Of course it is. It's always a possibility. I can't say it's a 0% chance. But if you look at the economic arguments, which people are saying, look, if we go on our own, we can negotiate better deals for Britain, as opposed to all the deals that are done now at a European level. I actually disagree with that, because I think having a bigger trading bloc to negotiate with gives you more power and leverage and gets you a better deal. So I think the economic arguments for leaving are actually quite weak. And certainly people in London are not going to want to see the UK leave, because London tends to be the financial capital of the European Union. Because of the markets that they have there, they won't want to see that change. However, it will depend on how the voters vote, and I think what we're going to see here is that some other social issues are going to come into play. People aren't going to focus just on economics. There are some social issues, namely immigration is a very big one in the UK that could see people vote against staying in the deal. And I would not be surprised come referendum day if we see a breakdown that's somewhat similar to what we see here in North America, in that rural areas of the UK will vote to leave, whereas the city urban centers will possibly vote to stay. The polls right now, people are a bit polarized because they were so wrong with their polls going into their election last year when the Conservatives won a big majority when they weren't supposed to win at all. So people don't necessarily trust the polls a great deal. And also, again, because of these social issues, it's hard to get a real decent pulse on the public. At this stage, I would be somewhat surprised if they decide to leave, but it's certainly something I can't rule out. If they do leave, there will be some great volatility. The pound will fall. The UK market will likely fall just because investment will come out of the UK. You get extra investment when you're part of the big trading blocks. Some of that money leaves if you decide to leave. So there are some huge implications here, not just for Britain, though. This is huge for the European Union, because if you have basically one of the biggest players in the European Union leave, that really does open the door to any other country to have their own referendum and get out of the deal. And then before you know it, this union, which has taken decades to put together, can easily fall apart over time. So there is going to be a great deal of uncertainty in the market if there is a referendum to leave the European Union. It's really hard to quantify, to tell you exactly what's going to happen to markets globally, but it certainly won't be a positive thing. On the Canadian front, you know, I don't need to tell you all that we are seeing the fallout now, of course, from the energy sector, which has been weaker since 2014. So this is not anything new to anyone. We all know what's been going on. We know that private investments basically dropped to half, which is half of what it was, which is really important because we're talking about $40 billion not going into the Canadian economy that used to go into the economy. And of course, some people believe that the budget was there to fix that, but you know, even if we run a $30 billion deficit this year, that's not going to be enough to fill the hole, so to speak, on private investment in Canada. So certainly we are seeing an impact in some of the data coming in. Certainly in the provinces such as Alberta, Saskatchewan, Newfoundland, we're seeing the fallout. Unfortunately, people are losing their jobs. And eventually that will translate into the consumer economy. Certainly those that have been laid off do receive packages, but eventually those packages run out, and then that could have an impact on consumption and certainly the real estate market in those provinces. So I don't think we've seen the absolute worst of this yet, and I'm not saying that it's going to get exponentially worse, but this is going to persist here for the next 6 to 12 months in terms of, unfortunately, I hate to use the word feeling the pain, but that there is more pain potentially to come. Now, some will argue, hey, we had a weak dollar before we went back up to 80 cents. Does this not help the Canadian economy? And to some degree it does. Don't get me wrong. If you're a manufacturer, you love seeing a lower loonie because your products now are cheaper and become more competitive on a global scale. However, the problem with Canada is that our country, which used to be quite a manufacturing hub, 40, 50 years ago, has now moved to a more service-based economy. So that lower loonie doesn't help as much as it has historically. So we can't just look to the loonie all the time to help us when the economy is not doing particular. The Bank of Canada understands this as well, and certainly thanks to some of the actually reasonable numbers we've seen compared to expectations in the first part of the year. The Bank of Canada, I think, is happy to stay pat for the time being on interest rates, and we could still see interest rates not change here for at least another year. So for those of you with variable mortgages and variable lines of credit, you're probably relieved at that. But at the same time, the big elephant in the room in Canada, of course, is personal debt. A lot of Canadians have too much debt on their balance sheets, and the big concern here is going to be when those rates do eventually go higher, which they will. There's going to be some Canadians in a really tough position to pay back that debt without it spiraling out of control and forcing them into bankruptcy. So we're fine for 2016. We're probably fine for a part of 2017. But once we start getting those hints that rates are going higher, then we have to have a more serious conversation in this country about debt and getting people weaned off of it.
Speaking of that, Gareth, just one quick question from one of the clients regarding real estate, obviously in Vancouver and Toronto, and with the rates remaining low. What's your comment on just the crazy real estate market that we're experiencing right now?
My comments on real estate, and if I can put it as simplistically as possible, even though there's a whole bunch of moving parts here, is look, real estate, I don't think in this country is truly going to be impacted until rates go higher. The fact of the money is, fact of the matter is that money is cheap, and when money is cheap, people will borrow it. And right now the banks continue to lend it, and that's why these housing prices are being supported at the levels they're being supported at, because there is a market with buyers that have access to this capital. Once that money becomes more expensive, it's going to put off people from borrowing it, and I think you will see certainly an immediate impact on the housing market. Now, some will say, look, some of this money coming into Vancouver and to a degree Toronto, it's foreign money. People are buying houses with cash. They're not taking out mortgages. This is true to some degree. I don't have the exact numbers as to the percentages. I think that that is going to continue as long as Canadian real estate offers relative value to real estate elsewhere in the world. So what I mean by that, for example, back in the 1980s, many of you may recall the people were told that, today we get told we have to learn Spanish and Chinese if we or should say Mandarin or Cantonese if we want to make it in the business world going forward because of where the growth is. Back in the 80s, you were told you had to learn Japanese. And it was because the Japanese were in North America buying up everything. They owned the Rockies, basically. They owned Pebble Beach, a whole bunch of real estate in the United States. Well, right now, ask yourself, where are the Japanese? They all left. And it was because the relative value in that real estate changed. And real estate values do change over time. I think that, and in their long cycles, don't get me wrong, it doesn't happen in just a year or two. But at some point, other markets will become more attractive. And this money that is trying to exit countries such as China will try and find a new home. I mean, for example, I was in Montreal last month doing a client presentation, and I was told there by several clients that Chinese money is now buying real estate in Montreal, which I found quite surprising because I'd never heard that before, but they're saying, look, they realize it's a lot cheaper in Montreal than it is in Toronto and Vancouver, and that's where the money's going. Eventually, Canada could become expensive relative to another country, and the money will leave Canada. I'm not saying that's happening anytime soon, but in terms of the foreign money, it is certainly influential today, but 10 years from now, we might not be talking about it as much. But to answer your question, Frank, certainly rising rates is what it's going to take here to slow this market down, and I don't think anything else will do that. I'm just going to briefly touch on the markets. Commodities, a tale of 2 years here. 2015, just an absolutely awful year in commodities. They were all down, basically. 2016 has been a different story. We've seen a rebound in many, certainly influenced here with the U.S. dollar weakening as it did, even though it's starting to strengthen again. Also a recognition, perhaps, that there was a big overreaction to the downside, particularly in oil. Some people said we never should have got as low as we did. It's all subject for conjecture. But point being is that a lot of these commodities have rebounded, at least in 2016, except for, as you can see, natural gas, because there still is so much of it right now in North America. But that translates here into my next slide, which is the TSX. As you can see, 2015, what did the market do? Well, it just kept going down. And that basically illustrates the relationship to, no, commodity prices did fall as much as they did. they are still extremely influential to the TSX index. The TSX index is a index that is heavily weighted still to materials and energy and financials. Now, the good news here, in 2016, as you can see, with the rebound of commodity prices, you've seen a rebound in the TSX, and our banks and insurance companies have held up relatively well. The financial weighting has been helping out this index still. So this performance in commodities does provide a pretty easy explanation as to why you've seen this V, so to speak, in 2015 and 2016 in the marketplace, and the hope, of course, is that that will continue. If you're wondering about oil going forward, still so much debate out there about what the actual price of oil should be, but on the whole, most commentators are still noting that there is still excess supply on the planet. As such, you're probably not going to see a huge rally from here on in on oil prices. Of course, anything can happen, but I think the expectation is that we take a bit of a time out here in the rally that we've had. Wouldn't be surprised if we went back down to revisit 40. Lots of people expecting oil to be range bound here for the next year or even two, although I think two might be a little bit excessive, in that 40 to 60 range. But also just a recognition that getting down to where whatever it was, $25, $26 that we were at the beginning of the year was indeed too low and too fast, of course. So the last thing I'll touch on here, Canadian dollar, because it all ties in together here with the markets and commodities with respect to our currency, with the expectation that we really don't move on interest rates for at least another year through the Bank of Canada, and of course with the expectation here that the Federal Reserve in the United States is going to move in this year at least once or twice, it's hard to believe that we can revisit that 80-cent level here, I think, for the rest of the year. I admitted at the beginning of the call I was surprised that we did touch 80 as quickly as we did. It was remarkable how fast the loonie fell. It was then just as remarkable how fast it rebounded up to 80 cents. I was really caught off guard by that and how many people were buying into the loonie. There was a recognition that it was probably oversold in the short term, but we could only really find reasons for it to go down rather than up in 2016. So that rebound was quite stunning. I think now we're kind of checking back into reality, recognizing where the Canadian economy is, recognizing where the new norm on commodity prices are, and as such, we are now, back in this, if I can call, let's say 76 to 77 range. Certainly a possibility for downside if we get more rate hikes out of the United States than expected, because as I said, in Canada, we're very unlikely to move within the next 12 months on rates at all. So I think going forward, probably expect more of the same, but certainly don't set your expectations too high for a massive rally in the Canadian dollar, because I don't believe that it will materialize. And with that, Frank, I'm going to turn it back to you.
Thanks, Gareth. So in summary, what you're saying is that the U.S. consumer at this point are starting to spend again. Rate hikes in the U.S. is not necessarily bad news, but it will affect our loonie, which will drive a little bit more volatility, something that we've interestingly been accustomed to over the last 3 months with currency, something something that we haven't seen before. Okay, and at the same time, money is still cheap, so we can see real estate in Canada still continuing up until that the lending rate is lower. And in your words, one man or woman should not be able to destroy the U.S. So regardless of who ends up in the White House, it would still continue on, and we'll look out on June 23rd, and we'll have a better idea of what's happening in Britain and their either staying or going with respect to the European Union. So anyways, thank you, Gareth, for your time, your outlook, and your insights. And I want to thank everyone who's listening here. On behalf of the Ortencio Group, I want to thank you for your trust in our team. We also want to wish everyone a safe and enjoyable summer. Thanks for tuning in.